Warren Buffett. Invest your way to wealth, not by saving money. Warren Buffett advocates for people to invest in themselves first and foremost through learning and development. That's because becoming a successful professional who supports is the route to financial security for most people, rather than becoming an investor professionally. Building wealth may depend on your professional competence, ability to advance in your chosen field, and willingness to broaden your skill set to create additional sources of income. What exactly is meant by the term value investing? Curious to know more? Now let's get deeper into this. Hello everyone and welcome to our channel. Remember to subscribe to this channel and press the bell icon to ensure you get all the updates. Let's start the video. The value investing approach that Warren Buffett pioneered is particularly well known, investing in equities that appear cheap with the intention of selling them at a higher price several years later. The theory behind this investment is that the market overreacts to mood and the media, which causes many stocks to be underpriced while others are overpriced. This strategy is out of the reach of the casual investor because it requires an in-depth understanding of the market and the business at large. As an added complexity, this may necessitate some advanced math. To determine whether stocks are underpriced, we must consider several factors, including companies' cash flow, earnings, sales, brand, business model, target market, and demand. Benjamin Graham's The Intelligent Investor and the essays of Warren Buffett, Lessons for Corporate America, are excellent places to start if you're interested in learning more about this strategy. As a placeholder, we'll review some of the fundamentals of Buffett's value investing approach at Berkshire Hathaway. Spend your money on brands you recognize. One of Buffett's tenets is to stick to investing in companies whose business model and industry you already know. Having this knowledge will make evaluating a firm and its offering much simpler. As a result, those with experience running their businesses may have more insight into what is more likely to be successful. Having been there oneself is not mandatory. However, what's needed instead of uninformed guesswork is a systematic, data-driven strategy. Your chosen firm should have solid values for success and a proven track record of financial stability. After all, your capital is in danger no matter what you put into an investment, and you're probably putting in a lot of it. Keep away from new businesses that rely solely on funding from other investors. You might be getting in on a bubble. Make your investments in organizations with competent leadership. Your interests as a shareholder should be aligned with the company's, and you should feel confident that the management team will look out for both. Warren Buffett bases his investment strategy on this guiding idea. The dividend policy of a firm might be indicative of its management. A positive indicator is dividend growth and buyback activity, both strong and stable. Consider the company's growth potential by learning how employees feel about their jobs there. Companies with happy workers are more likely to succeed and retain top employees, whereas those with dissatisfied workers lose talent and intellectual capital. In addition, if you care deeply about doing good with your money, the treatment of employees should factor heavily into your final decision. A long-term investment is recommended. Warren Buffett uses a long-term perspective in his investments. Investing isn't about jumping on the next bandwagon to sell out a few months later. Sound investing entails putting money into companies you believe have a good shot of doing well in the long term, resulting in excellent returns on your investment. Remember that it could be several years before an inexpensive company reaches its full potential, so you may need to be patient if you invest in its shares. In a nutshell, it's not a get-rich-quick scheme, but rather a become wealthier gradually perhaps. 1. This endeavor demands time, effort, and capital due to the lengthy time that money must be stored, yet it needs to be as nerve-wracking as the more rapid trading method. The time is to invest during a market panic. Long-term stock market volatility tends to level down. You're not looking for a speedy return anyway, so it doesn't matter if the stock market is failing. A solid business with solid performance can weather market downturns. Investing in the stock market while it's down can help you find hidden bargains. The difficulty is picking a firm whose stock price has dropped, but is still strong enough to weather the storm. The catastrophe brought on by COVID-19 is a noble illustration of this phenomenon. Many companies have had difficulty directly from this crisis, raising serious concerns about their ability to continue operating. You should refrain from throwing good money after bad at a failing business. This is it, everyone. So what do you think? Leave a comment and let us know. Thank you for watching the video. Remember to like the video and subscribe to the channel if you still need to. Also put on the notifications because the following video is going to be a great one.